Hello and welcome to this week's US Stock Market Report. I'm Dale Gillham, Chief Analyst at Wealth Within. This week I'll be discussing the advantages and disadvantages of leverage trading, and then I'll dive into the Dow Jones and this week's stocks of interest. Before we jump into the report, I'd just like to mention that if you have any thoughts on this week's report, please comment below and be sure to subscribe to our channel to keep up to date. So let's get into this week's report. Leveraging is one of the most powerful tools traders and investors have in their toolbox to increase returns. But before we discuss what leverage trading is, let me share a quote from Warren Buffett, who said, "When you combine ignorance and leverage, you get some pretty interesting results." I totally agree with this quote, simply because in the right hands, the use of leverage can dramatically increase returns, while in the wrong hands, it can have a devastating effect. Remember, high reward goes hand in hand with high risk, and leverage trading, which is utilized in markets such as forex and contracts for difference, is a very risky strategy to apply in your trading if you do not have the right knowledge and experience. So what exactly is leverage trading? Well, leverage trading, which is also known as margin trading or trading on margin, allows you to open a trading position using a small amount of capital in order to take a much larger position in the market. For example, if you have $1,000, you can leverage your trading position up to 100 times or more. So if you leveraged at 100 to 1, you would be exposing yourself to managing a position of $100,000 in the market. When trading on margin, the margin itself is typically expressed as a percentage of the total position size. For example, forex brokers will say they require 1%, 0.5% or 0.25%, which allows you to calculate the maximum leverage you'll be exposing yourself to when opening a trade. So if you put up $1,000 and decide to open a leverage position on a 0.5% margin, your exposure in the market would be $200,000. Obviously, you don't need to be a math genius to see that this has the potential to make or break you very quickly. Leverage trading has become an extremely attractive option for investors, given that it allows them to fast-track their potential returns. But the downside risk is, as Buffett alluded to, it is those who are uneducated in trading these markets that can least afford to go down this path. Unfortunately, it is the individuals with little capital and knowledge who are attracted to these highly leveraged markets because they believe they will become much wealthier in a shorter period of time than from any other method of trading. Just Google leverage trading and you will see an overwhelming number of websites that cater to this way of thinking. However, it is important to understand, if you want to succeed in trading over the longer term, that the number one rule in any market is the higher the risk, the greater level of knowledge and experience required to manage that risk. So let's take a look at the pros and cons of including leverage trading in your overall wealth creation strategy. As I've already alluded to, one of the advantages of leverage trading is that it provides you with access to additional funds, because you're borrowing money from the broker to gain more exposure to the market than you otherwise would. As you're exposed to larger positions in the market, you have the opportunity to magnify your returns. For example, let's say you decide to enter into a forex currency trade on the Australian dollar US dollar currency pair because you believe the Australian dollar will fall in value against the US dollar. Now let's assume you decide to trade $500 on margin at 0.5%. Your exposure to the market would be $100,000. So you're now controlling $100,000 trade using only $500 of your own money. Now let's assume you were right in your assumption about the Australian dollar falling. So your $100,000 is now worth $102,000. Therefore, if you decide to exit your position, you will have made $2,000 on an investment before costs using $500 of your own money. Now that's a gain of 400%. Obviously, you can see that the use of leveraging will dramatically increase your profitability as a trader. However, there are always two sides to a story, and you need to consider the risk, as margin trading can backfire on you pretty quickly if you get your analysis wrong. Because just as leveraging can magnify your profits, it can also magnify your losses. Let's continue with the previous scenario, but let's say that instead of the Australian dollar falling, it rises against the US dollar. so that you now find that your open position is sitting at $98,000 or a loss of $2,000 on your initial exposure of $100,000. This means you're down 400%. So not only have you lost your initial capital of $500, but you are now required to cough up an additional $1,500, as the broker will have made a margin call on your account to cover the losses. In fact, forex brokers will require you to maintain a certain amount in your brokerage account to cover margin calls in the event the trade goes against you. You also need to be aware that when you open a forex or CFD trading account, you will be required to sign documents that state the broker has the right to recover any losses from you if they exceed the money in your account. And I am aware of some pretty horrific stories where individuals have lost substantial amounts when trading these markets that have cost them their savings and sometimes their house. It is for this reason why it's vital that you acquire the right knowledge and experience before you decide to trade these markets. Because, as I've always mentioned many times before, your education will cost you one way or another. Do you know that 90% of individuals who trade these markets end up broke, or at best, they break even? Furthermore, the lifespan of most traders who trade highly leveraged markets is measured in weeks and months. This is why there is so much marketing hype with the promises of riches around leveraged trading, because the brokers need to continue to entice new people to take up the challenge. Imagine having a business plan where you can predict that every 9 in 10 traders will lose most, if not all, the money they placed in their broking account. It would make for a very nice business model. Well, this is the reality of leverage trading. If you don't have the knowledge or skill to manage yourself in these markets, you will ultimately lose, and the brokers know this. I know some of you won't hear the message until you actually experience it, but the statistics don't lie. We all know there is no such thing as get rich quick, yet so many are attracted by this hype. But what if you could get rich slowly? Well, that is what I'm promising when I tell you to get a proper education, because it will repay you in spades. In fact, one of the strategies I teach my clients is to never invest all your money in trading short-term, highly leveraged markets. Instead, you should allocate 90% into medium to long-term portfolio and invest the remaining 10% in leveraged markets. The trick with this strategy is to have the 10% allocated to trading short-term, highly leveraged markets and have that achieve equal or better returns when compared to the other 90%. This strategy is not only very achievable, but more importantly, very repeatable when you have gained the required knowledge and skill to trade these leveraged markets. I outline this strategy in detail in my latest book, Accelerate Your Wealth. It's your money, your choice. So head over to my website and purchase your copy. I can categorically say that if you follow my advice, you can become one of the 10% that consistently makes money in the markets. So there you have it, the pros and cons of leverage trading. Now let's get into this week's stocks. Alrighty, on your screen right now is a weekly chart of the Dow Jones Industrial Average, and it's last week was what an interesting week that was. I mean, you can see the Dow opened right on its low and closed right on its high. So it opened at 24,364 and it closed at 25,538 for a range of 1,185 points. Now, stellar rise, and if we go and look at the daily chart, you can just see how much of a stellar rise it was. It just went bang, 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 and closing right on its high for Friday the 30th there. So spectacular. I wouldn't necessarily assume, I think it would probably have 1 or 2 days down this week. It may happen on the Monday or the Tuesday, or might start on the Tuesday, but I'd say 1 or 2 days down or a bit more. And it really has surprised me in this really strong bullish sort of move here, moving up. But it still remains to be seen whether the Dow is going to return to being bullish. I'm quite confident it'll be bullish next year. That's not a big issue, but I don't think it's washed out enough yet. I think, I'm still thinking it should go below this 24,000 and down to this 22,000. So we may get a washout over a few months, but I think we're going to have a pretty good 2019. It's interesting when you look at the markets and you look at gains on the marketplace. And if I just use my little tool, price range percent, let's just go back to November, December. Where's that? That's December. And December, end of December, there's the 5th of January, there's the 29th. So where it closed at the end of December to where we are now, the market's only gone up 3.3%. And you generally, when you look at the history of the market, you don't see more than, generally don't see 2 years that are really, really subdued and volatile. It can happen, but you don't necessarily see it. So it'll either be more bullish or more bearish next year than this year. And that's probably pretty easy to say. It's like a 50-50 bet each way, isn't it? But I'm suggesting it will be a bit more bullish in the coming year than what it is at this point in time. I just not convinced that it's finished falling, and that's really where I'm at. I still think it's got more to fall because I don't think it's fit its price target or its time target for its fall, but I'm prepared to be wrong and sit back and watch. But right now, I just wouldn't be getting into the Dow, and I'd just be watching some of the stocks. And there's some awesome looking stocks on the Dow, but right now when you look at the FANG stocks, which we looked at in last week's recording, they're all looking a little bit bearish. They're a bit too early to buy. When you're looking at banks, which we looked at a few weeks earlier, none of them are super, super exciting. Technology stocks aren't looking brilliant at the moment in the US, and they make up around 25% of the S&P. So again, they're the banks and the technology stocks need to start moving up for the S&P to start moving up quite nicely. So this week I wanted to go back and just revisit stocks to watch the stocks that were on the hot list, I suppose, if that makes sense. So these ones recommended by, I just Googled, hot stocks to buy in the US today or this year. And these are some stocks I got, and I like looking at those. And the reason why it's interesting for me to see it and I keep saying to people, don't take tips, know yourself what you're doing. And I will say to you, when you do all the research about experts and expert tipping sheets and newsletters with tips on it, people get them because they think, well, there's an expert, they can give me a tip, it'll save me time, and then I'll pick better stocks to buy. But the interesting thing that most people don't consider, it's not buying, it's when you sell, it's more important. Because anybody can flip a coin and get 50-50 right on any stock, and you can keep picking stocks, but it's knowing when to get out and how to get out and what the right time is to get out and how to manage it. It's the process that you need to take. And if you are uneducated, it doesn't make any difference who's giving you these recommendations. You will still lose money and you'll still lose sleep because you'll be hanging on to stocks too long. You won't be getting into the right time. You'll put too much in some, not enough in others, and the process will be all out of whack. And it really is critical that you learn how to buy and sell, not just get stocks to pick, because you could have a great stock picking report or somebody giving you lots of stocks to buy that are great recommendations, and I guarantee your return will still be average at best, simply because you won't do the rest of it right. That makes sense. There's no use sort of driving a car when you only know how to turn it on. You need to be able to steer it and put the brakes on, avoid collisions, drive it safely and get to where you want to go from point A to point B. And if you don't have the rest of those skills other than turning it on, then you're going to be quite dangerous on the road. So right now, this one's Starbucks. I've never looked at Starbucks before. I've drunk their coffee before. I don't like their coffee. I suppose a lot of Australians don't like Starbucks at all. Starbucks doesn't do very, very well in Australia at all. But when I'm in the US, that's all I drink is Starbucks because it's okay. But not to put down the company, but their coffee's not as great as some of the stuff we get over here. But it is a good company, and it's a very, very well managed company, and it is quite a popular company. And right now, this thing just looks like it's bullish. This looks like it's going to keep going up, and I think we've got some really, really nice potential on this. So if you're looking for a stock, I think this would be one of them. I think this is a good pick by whoever picked it, and I don't know who picked it, but if I just put a couple of tools on here, I'll just have a quick, basically have a look at this. Let me just whack this over to this one. Actually, I'll whack it over there. And if we drag this down, you can see here, I'd probably look at going up to around $78 in the short term, possibly getting right up to $93 in the longer term. And if you're looking at that from a time, if the Dow, there's a lot of talk about the Dow crashing and everything else, but look at that, that's 17% up to 40%. So I think that's a good trade, this stock at this point in time. Now you need to satisfy yourself as to whether this stock fits your rules for your portfolio, also your buy and sell rules and everything else. But looking at this, we have 5 weeks up. I would suggest what quite often happens when you get a bit of a move through some of these sorts of patterns is you'll get a come back down again. So you'll get probably a comeback. So if I do a nice little this one, you'll probably find that this stock
this week probably could come back down into this sort of level, that $58 to $60 level. It might have 1 week down, 2 weeks down, and then after it starts to move up, that's when you're starting to look at a place where you look at buying it, because you quite often will see a retest of these patterns. So probably good looking stock, does look like it's going to be bullish, but you might be able to get a better price if you sit back and wait. But again, your choice on what you do. Let's move on to the next one. This one's called NXP Semiconductors, and obviously the name tells you exactly what they do. And if I do the whole history, it has been a very, very bullish stock. Since it floated, it was $10 up to $120, looking very, very, very nice. Looking at it now, it's been quite bearish, and I don't see any reason why it won't continue to be bearish for quite a while. It looks like a little bit more of a lower volume, sort of more illiquid type of stock. There's plenty of shares traded in it, but it doesn't look brilliant to me at this point in time. I'm not as excited about this one. But, if I put something like this into it, and we click on here, I would suggest it's probably got a bit further to fall. It'll probably fall down to that $62, $63 mark over the coming months, just as it readjusts back to its normal sort of momentum is what I talk about a lot of times. Is the momentum and volatility of the market, and you can see here, this is now, it moves up and around this sort of blue line. It's below it at this point in time, which suggests it is getting to its low. It's probably done 80-90% of what it's going to do to fall, and then it'll start to move back up towards this blue line, because if you look at the time it spends above it and below it, it spends more time above it than below it. But it does spend some reasonable time, so it might spend a month or a few more months underneath it and then start to move back up. But if, let's say, it does move down to this 50% level, so that's $62, $63, roughly around there, that's a fair whack of move to get right back to that trend line. So it's worth waiting for, and this is what I'm suggesting, is often traders say, wow, it's starting to move up, I'll jump in, and a lot of traders jump too early, only to see the stock fall away again, and then they're getting stopped out and lose money. Patience is a virtue, and trading should teach you patience, but you should be patient with the market. It's about stalking the market and looking for great buys, not being a victim to the market and chasing buys. So wait, bang, get in, get a good return, rather than jump really, really early. And that's one of the big things I teach a lot of traders. This one here is called Stitch, and they're in... They actually, from what I can read, they actually send out fashion ideas and tips and everything else. And this one, again, was one of those ones that sort of stocks to look out for. And right now, there's probably not a lot of data on it. It was hugely bearish. Obviously, it fell out of bed through here. If I go and put my little tool on, it's fallen, what's that? It fell 57%. Which is, again, it's one of those volatile stocks, and I did most of it in October, so you can see a huge big move down. This could just be a consolidation before it falls down back into this pattern here, which is probably likely to do, but it may not. It's not a highly liquid stock, but if I push on my other tool, you can see here it fell through this sort of 50% level. My suggestion is it'll probably get down to this $20 marks, and I think right now it's not a stock we'd buy. That said, I'm not discounting. It might move up a bit in the short term. It might move up for 1 or 2 weeks or 1 or 2 months and then fall the way down to this 61.8% level. But right now I would stay out of it again. And that's why I say these hints and all these tips and these hot tips, which is this one was out of an article, it's hot tips for 2019. And I'm not discounting it won't go up, but again, you need to be careful. Don't just take a stock tip and go, yeah, I'll buy it. It's when do you buy and when do you sell? It's really important. And how do you do that? It's even more important. And this is where people doing my trading mentor course, only $1,497 is dirt cheap. You get to email me. I'm your mentor. Just for a little bit of education, you'll learn a lot more about when to buy, when to sell, and have a lot more confidence and more control over your trading. And you'll repay the tuition fee in no time flat. You get 6 months of emailing me to be your mentor and the 11 lessons that go with it. So just have a think about it. Get online, make yourself a Christmas present, click buy, and then we can start helping you make some good money. So let's move on to the next one. It's called Centene Corp. And looking good. This looks really, really nice. It's one of those stocks that can have some good trends, and it had trends both up and down. That was through to there. Then it just took off like a rocket, and you can see very euphoric buying. It hasn't had a major pullback since this one back here in 2016. That was February 2016. So right now it's doing a bit of a consolidation phase here. It remains to be seen how it will keep up. I'm not going to be excited till it breaks through that 148.24 because it could turn over and fall over given it's vertical. This says to me that unless it has a big fall, and I'm talking about if I go here, around this sort of level, $91, it needs to have a readjustment, and it hasn't had it at this point in time. When you get this euphoric buying, it doesn't last forever. You're on the last stages of it. So any move up now is all the people that didn't get in here and think, wow, it was 100, went up to $148. That's 50% growth in a matter of months. Oh wow, it's cheap now at 122. If it does that again, doubles, goes up another 50% or doubles in the next 12 months, I'll make X. Whereas it doesn't do that. So these people getting in now are the ones that missed out on all this run, and they're going to run out of money soon, and then it'll tip over and start to fall away. So this is one I would stay right out of. But hopefully you've enjoyed this recording. Again, if you haven't bought my book, Accelerate Your Wealth, yet, it's in all bookstores, all good bookstores right across the US, or on Amazon. You can buy it through there. Or get onto our website, wealthwithin.us, and you can order it through our publisher in the US and send it straight to you. You'll love the book. We're getting huge feedback across the US on radio stations and other people professionals that are reading it and loving it. And so hopefully you will too. So get in and get your copy today. Talk to you next week. Bye-bye.
What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on SoundCloud and on our website. Now they're jam-packed with valuable information which will help you elevate your trading. Now, if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.